Hey, what's going on, Cashflow hackers? It's Chris, Life 180, and I got my buddy Tom Wall here, author of Permission to Spend and the, founder, architect, host of Whole Life Masterminds.
Yeah.
And just a really amazing guy, a wealth of knowledge, PhD in life insurance, or PhD in what?
Retirement income planning.
Retirement income
With
planning.
a dissertation in life insurance and in retirement.
Wow.
Yeah.
All right. Well, rock and roll.
Yeah, good to be here.
Everybody who watches my channel, you know that I'm a very analytical person. I spend more time on my board and drawing things out. And so it's really cool to have a fellow nerd in the studio with me.
Unapologetic.
Unapologetic nerd in the studio here talking. He's actually in town, as you can see, he's in the studio with me, speaking at another event for an agency and had a couple hours. So we're going to film some content. So, I think the best place to start, and I want this to be just kind of a fun video where we're talking about just the different ways we can utilize whole life insurance. You wrote the book, Permission to Spend.
Yep.
So I think it's a great place to start. Talk to me about how you see whole life insurance being an asset that gives you permission to spend, because, and before you do, I want to say this with the preface and the pretense of the fact that I think I wind up going up against a lot of IUL agents and a lot of people that I, quite frankly, get into some battles with here online.
Yeah.
And they're all about put all of your money into IUL, put all your money into whole life insurance, and that will be all you ever need, right? Like when you get to retirement. So kind of talk through your perspective on how life insurance fits into a retirement income planning scenario, and I'm going to just let you roll.
So I think,
good luck.
I think everyone's different. I mean, you can put all your money into life insurance and it's guaranteed to grow and you're going to get a reasonable return on it and there's tax advantages. Like you could do that, but that's not diversification. And, starting businesses, owning real estate, equities have historically given you the real upside where you can create generational wealth. So I view it more as a strategic asset, which can be in the portfolio to borrow against, to invest in those things or make those investments.
Well, and I got to say, I agree. I see it the same way as far as how we use it and what we coach people to. I'm going to push back a little bit at the front end, though. It's like, yes, you can do that, but when it comes to IUL, doing it, it comes with a lot more risk than is ever told.
Correct.
Okay, I just want to make sure that, I don't want anybody taking what he just said and be like, oh, he said I can do it, so.
I was talking about whole life.
Okay, all right.
So my book calls Permission to Spend. It's really retirement planning 101, but it ends with talking about annuities and life insurance as your permission to spend, because here's the issue. I realized this early in my career and spent many years trying to solve this puzzle. It all kind of comes back to the 4% rule, which, believe it or not, was 30 years ago that study was done.
I know.
And
we're getting old.
I know. But it's basically, retirees are going to show up at retirement regardless of what their portfolio looks like, and they're going to be terrified to spend because they can never go back to work and earn more money. They're afraid of what happens if the market crashes. They're afraid of what happens if they live too long, require expensive ongoing medical care, like long-term care that's not covered by their health insurance plans, or just need access to liquidity. So they don't annuitize their assets because they're afraid of needing that access to capital. They're underspending. It's really an epidemic right now where retirees are. There's been study after study shown they're underspending in retirement because they're basically acting like their own insurance company.
And they're scared.
They're hoarding capital just in case bad things happen, which probably won't.
Right.
It's almost like self-insuring for your car. That would just be a stupid decision. So. For me, the whole book is kind of like, hey, if you're going to have some obligations to other folks in retirement, at the very least, you're going to need to make sure your spouse is taken care of. But most people want to leave a little something to the kids, or maybe their church or charitable interests.
Sure.
And permanent life insurance that is going to be there, that doesn't require management. It's guaranteed to be there, like whole life insurance. That can provide that guaranteed backstop, so then you can invest more aggressively elsewhere, longer in retirement or closer to retirement, and take income. And your worst case scenario is pegged versus just everything being a variable.
How do you feel about, and I didn't prep you for this at all, so I don't know how you're going to feel about it, but there's different companies have different types of products. There's the pay to 121 kind of deals. There's the L99, L95s, L90s. There's different companies have select products that pay up at 65, Lafayette has one that pays up at 75, right? Like all these different ways that you can fund, and all the different ways you can get limited pays, like 10 pays, 15 pays, 20 pays.
Yep.
What's your interpretation on the different use cases for each type, and who is maybe the right fit for each one, and so on and so forth?
What's interesting to me, it's a little less true today when all the products got updated a couple of years ago.
Yeah.
But generally speaking, historically speaking, over a long enough time frame, they're all the same. So you can overfund a 10 pay, and it's very cash rich early on, which may make you feel good.
Yeah.
But when you go out 40 years, the IRRs are about the same as they are on a pay to 100 contract. Yeah. And again, you got to remember, like unless you either go broke and cash out of the plan or just have a bad advisor, you're probably going to die with that thing in force. So it's really the IRR on death benefit, which is what you should be looking at, is what is the ultimate, I call it the inevitable gain for my family on that life insurance contract. The cash value in the short term, unless you cash it out, really doesn't matter all that much. I mean,
well, if you want to use it for real estate investing, or if you plan on leveraging it, which we do a lot of, we coach people to that.
Yep.
That's part of it. But what do you like? I guess here's my thinking is like, if you have a full pay, somebody that has like an L99 chassis product, a lot of times what they're doing is they're basically spreading out a lot of the mortality charges over a longer period of time, and so they actually perform better from a liquidity perspective. You could design them if you wanted to talk about it from like the high early cash value kind of like elements to it. You can design those policies to have more liquidity earlier because the mortality charges are less, right? They spread it out.
Right.
Whereas the 10 pay chassis, you can do some things to it, but they're compressing the mortality charges in a shorter window of time.
There's also less mortality charges too, because usually those dollars buy you half as much death benefit or less. Right. So that's a part of it too.
But then you also have a situation where, like, you and I are in our 40s, right? I don't know. How old are you?
42.
42. I'm 43. No way. All right. So basically the same age. So we're in a position, like, if we were to buy a policy right now, let's say we had a choice to get a 20 pay policy that would be paid up by the time we're 63.
Yep.
62. You'll be whatever tomorrow.
Close enough.
So and then or we could do an L99 that we're going to have an obligation to make a payment, or at least have premium offset, or do something with the policy where there's an inefficiency from any time we want to stop paying on that policy if we don't have the cash flow in our life to pay for it. And I know a lot of people have a big hesitation of being like, why would I want to pay premiums into a whole life policy after I'm retired?
Yeah, it's a good point, but I think I take a different approach. I think it's options and flexibility. So my primary policy, I own a bunch of them, but my primary one actually is a pay to age 100 contract.
Cool.
Because when I ran all the numbers, that was the biggest bang for my buck in terms of the highest IRR on death benefit, which I know is going to be what I care about. I'm not going to cash these things out. I am going to have significant net worth to pass to the next generation.
Yep.
And if my cash value today is 100 grand or 80 grand, it's kind of the same thing. I mean, I'm not going to probably leverage every single penny in that contract.
Sure.
So for me, the lifetime benefit is what I went for. But but individuals, I mean, they like having an end. The psychology of it.
Well, they don't know what they don't know. They haven't gotten a PhD in this stuff.
Well,
right?
there's also the non-forfeiture benefit of all these policies too. You can always take it reduced paid up. I can always take $1 million and turn it into 600,000 and just walk away forever. It's not as efficient as an overfunded design up front. Long term that would cost me to do that, but it is an option.
What are you when you talk about the reduced paid up? A lot of times when you do the reduced paid up feature, and I realize some people sell policies that don't have living benefits associated with them virtually at all. But a lot of the times when you do the RPU function, you lose the living benefits.
Right.
So
that can be a tough
something you gotta check out, and that's
for sure.
Like with some of these companies, doing a 10 pay, 15 pay, 20 pay, the limited pays, all the costs are built into it, including the fact that when it's paid up, you still keep the living benefits forever, which is kind of a cool thing, right?
Yeah, that's
like, so I guess this is why people always ask me, like, Chris, what's the best policy? It's like, there is no right policy. It's like, what's important to you? That's like, the best policy is the one that's designed to fit your goals and objectives and your needs and like the things that you value. And I think, can you speak to this a little for me? Because like I talk about it all the time, but I always love to hear it from a different voice. Is like how flexible life insurance, whole life insurance can be to solve different problems for different people at different stages of life.
Yeah, it's been called the Swiss Army knife of financial planning. There's a reason for that. I've called it tax advantages without limitation. And of course there are limitations on, how much of the policy the company will give you, but there's no funding limitations like other tax advantage vehicles like IRAs or 401ks where it's pretty strict and then very strict on how it comes out and for what. So the flexibility to use cash values for whatever is a big piece of it. But yeah, you mentioned, long-term care benefits are now ubiquitous across the industry.
Yep.
Very few people buy individual long-term care anymore because it's just so expensive.
Super.
If you can even find a good contract out there.
Yep. No, that's true.
So that's a big piece of it. But just going back to your original question, though, I think most people would benefit most by having a policy that kind of matches up with their retirement. So if you got 20 years to retirement, a 20 pay is great. If you're a business owner or you were interested in making real estate investments, maybe fast forwarding that funding could help you because then you can do the kind of infinite banking approach where you borrow money and then
deploy
buy
the capital
and then,
a little bit more
and
effectively.
Rinse and repeat and all that stuff.
Yeah.
And I think for a lot of clients that I come across, especially as they start getting older or closer to retirement in their 60s and 70s, it's no more a conversation about cash value, although that's important to them.
Sure.
It's really more about how do I keep as much of my wealth out of the IRS's hands? And that's where the death benefit function is paramount.
And when you're talking about out of the IRS's hands, you're talking about once you put it in, it's going to grow tax deferred. You're going to have access tax free if you need it through policy loans. Yeah. And it's going to pass on from a legacy perspective to the next generation.
Yeah, and even the truth is most Americans, their two biggest places of wealth is their home equity and their 401k or their qualified plan, whatever that is. And qualified plans have RMDs. You're going to be forced to take that money out someday, which is fine, but usually in life it's better to be proactive as opposed to being reactive. So having a strategy for where that money goes and providing a home for that money is important.
So you deal a lot with, with the background that you have, you've had a lot of history working with higher net worth people, more successful people. I can tell just in the way you talk about it, right? Yeah. And so we deal with a lot of that as well, but we also get a lot of people that are coming through being like, all right, Chris, it's great. It's great that it works for those people, but I make $80,000 a year and I am lucky if I can save $10,000 a year. Like, how does this work for me? And so like those people, when they hit retirement, they're not worried about RMDs. Like they're worried about even having enough money. You know what I mean?
Yeah.
So talk to me about how whole life insurance could work for somebody like that in your eyes.
Well, that's a fantastic example because, when you have, limited resources, it's much harder to be diversified in meaningful ways among different vehicles. Yeah. So if, with the whole life insurance contracts, I always say, I get really mad at advisors when they call whole life an asset class. It's not an asset class. It's a life insurance contract, but it's backed by a portfolio. And the dividend performance is based on the way that portfolio of mostly bonds is performing. So, the average investor, if you will, can look at their whole life insurance policy as an alternative for their savings account, as an alternative for their bond allocation in non-qualified funds, meaning outside of your retirement plans. It can also help them save for college. So, you can use it to do double, triple duty for those things, with scarce dollars, and then, be strategic like we talked about. So I even for younger clients, it's a great way to kind of start that emergency fund without.
I love it. I want to go to the board real quick because I just have to do this. So one of the things I always talk about is like life insurance grows with you. It's the only asset class that I know that you can start when you're in your 20s, right? So you could start in your 20s and it's like your emergency fund, right? Emergency or like savings, right? Because we all need to save. And one of the things I'm really passionate about is like teaching people I believe personally the biggest lie in personal finance is the younger you are, the more risk you can take, because I think the younger you are, the less risk you have to take, right? Yeah. It's an idea. So most people would look at that and be like, I'm in my 20s, I don't need life insurance. But I would say you need to save money before you invest, right? Yeah. And your mortality expense when you're in your 20s is going to be lower than it's ever going to be. And if you ever plan on getting married, imagine being proactive and knocking out your emergency fund needs and locking in a certain amount of life insurance to make sure that when maybe you're in your 30s, you have the life insurance coverage that you need for family, right? And then as you get older, this money's going to keep growing. So when you're like 45 or so, it's going to be college planning that you could use, and it's going to work really well for you for college planning.
Yep.
And then all the while you're going to have or like say when you're 50 to 65, when people start having higher rates of cancer and disease and stuff like that, which hopefully that doesn't happen to anybody, but you have the living benefits, right, that go with it. And then when you're 65 plus, you have like a volatility buffer, which you love to talk about, and living benefits, right? So we're talking about one asset that starting in our 20s accomplished all these different things and grew with us. And by the way, the whole time you had liquidity of that money, the whole time, that if you wanted to take it and leverage it and utilize it for real estate, you could do so.
Yeah.
Do you know of another asset in the world that can do that for you?
I do not, but I want to go back to this point. I love that point that you made.
Okay.
That the younger you are, the more risk you can take. Now, you ever heard of the article written by Moshe Milevsky?
No.
Dr. Moshe Milevsky, he's written a bunch of books, usually about income planning and annuities and stuff like that. And one of his concepts is, are you a stock or are you a bond? And basically thinking about you yourself as part of the asset allocation. So if you work for the government and you're going to get 3% raises the rest of your life, you're a bond. Okay. You should be shooting for the stars because that's your only hope to actually get wealthy. Okay. But if you're a young professional and you can, and the stability of cash value can give you the ability to job hop or start your own business, I mean, you can double and triple your income in 5 years.
Huge.
So what's the point of investing in the market and making your money illiquid inside of a retirement account if you yourself are a stock? So I love that thought process. Like think about yourself, the human life value in the equation. Yeah. And then things change pretty quickly.
Well, one of the things I've been talking about a lot lately, because I think, I love cash value life insurance. I love what I call cash flow hacking and doing the high early cash value and leveraging it and doing real estate, using it for business, all that kind of stuff. Yeah. I think that's great. But one of the things that I've started talking about a lot lately is buying your human life value, right? So if you buy your human life value and then build your cash flow, right? Yeah. So if you do and that's basically what you just said. You have the ability to go out, the insurance company, and the only problem I have with the human life value concept is like insurance companies putting like a value on what you're worth or what I'm worth or whatever. And I mean, they have to do it. I get it, but.
And if you don't know what that is, it's basically a present value of your future earnings. Yeah. Based on what you're making today.
Exactly. And that's not even across the board, right? Because everybody's got a different growth curve. Everybody's got different skill sets or whatever. I get why they do it the way they do it. But, I also have a hard time telling somebody like, here's what you're worth, right? Like, because some people are worth actually way more than the insurance company will get them. But the point to that is you can never get too much insurance.
Right. Yeah. You
know what I mean? Yeah. A lot of people think like, why would I go out and buy that much? It's like, if the insurance company is willing to give you, you should probably get it. Yeah. If they're willing to give it to you, right? Like that's kind of my mindset. Maximize this human life value. But what I do is I do it through convertible term. We use convertible term. And then whatever we do, we take based on cash flow, we'll figure out, well, how much of that cash flow, let's say there's $10,000 a year of cash flow and they need to save because we need to save before we invest. Right. We figure out first and foremost based on what's the human life value, splinter off maybe, $2,500 per year of that to go into a convertible term to maximize the human life value. Yep. And then we got $7,500 going into a whole life policy. Right? Sure. And that would be the way that we can do that. And then as we're doing that, the human life, the 7,500 can help build cash flow. We'll do it in other areas. We'll increase our earning capacity. We'll do all these other things. Yeah. And as we do that, life just gets better and better and better. It's the only way I know to create predictable results with your money.
For sure. Yeah.
Am I missing something?
No, I think
you're a PhD. I'm not. So.
Honestly, I think that predictability is so huge at those younger ages because I look at my own career and, multiple times I had opportunities to job hop or do things. And I was just, I had a family young, so I had obligations and I wasn't willing to take those risks. But I built that war chest versus putting that money in my 401k, which I couldn't really touch. I might have felt more comfortable doing that at an earlier age. So it took me a long time to get there, maybe all 20 years of my career. But, lately I've kind of really come full circle on that.
That's awesome. I love it. Is there anything I'm missing on this stuff? I mean, we both talk about this all the time, but
I don't think so. I think
it's pretty good start for this video.
Yeah, for sure.
Yeah, awesome. Well, guys, Here's the deal. Tom wrote a book, Permission to Spend. We talked about it before. I'm going to put the link so you can go get that book. Where do they get it? Is it a website or is it only on Amazon? Like, do you have a...
Amazon in all formats.
Amazon, all formats. So go to Amazon. I'll put the link to the book down below so you don't have to search for it. Go get it, read it. It's an amazing book. If you're really looking to figure out the details and the nuanced details, you do a pretty good deep dive on this like a lot of this concept, right?
Yeah, absolutely.
So it's awesome. So go check it out. Thanks for being here. We're going to do another video now, so make sure you're subscribed. Hit the bell that way you're notified when it launches. You also have a YouTube channel. You're on Instagram. Not much of a YouTube channel.
Not much of a YouTube channel. Yeah.
We're gonna fix that.
We'll get there.
We're gonna fix that. So yeah, I'll help you build a YouTube channel.
Yeah.
So he needs to be on YouTube. But go follow him on Instagram. I'll put that in the description below as well because he creates great content there. And go check out wholelifemasterminds.com if you're an agent. If you're looking to learn, amazing content, amazing guy. You'll learn a lot, and that's it. Thanks for being here, brother.
Awesome.
All right. Have a blessed, inspirational day. We'll see you guys soon. Later.